Here's another email that I received from an insurance company talking about really the benefits of diversification. And I'm curious about this because I'm looking at this and I'm a little concerned by the volatility that they're discussing. And that's kind of the point that they're bringing up. So let's talk about this. Correlation of monthly returns with the S&P 500 index. Before we continue this, just want to let you know that we're not giving any financial advice here. We're just giving some education. Though we are financial advisors, this is more educational based. We don't know your situation as you're watching this. We don't know your what your concerns are, what your goals are. So really, this is for educational purposes only. And everything you see on this YouTube channel or any other communication that you get from us is for educational purposes only. Until you speak to us directly and we have a conversation with you directly, we'll understand your situation directly, and you have hired us, is at that point in time, are we giving financial advice? Okay, so let's talk about this correlation based on, so what they're doing here is they're breaking down each of the equities, fixed income, and commodities sectors, and they're looking at the blue as the normal period, the blue, and then the orange is the volatile period. Now, if you look at the orange, is exceeding really every aspect of this, and this is from Bloomberg, this chart. And so let's talk about this and what they're kind of discussing with us and what we need to be concerned about, in my opinion. Recent years, the equity markets has been seen rapid expansion. The average daily trading volume has increased from 7 billion all the way up to what? 14.7, doubling of the trading volume. Okay, that's pretty spectacular. It's important to know. What that means is that, does that mean that there's more US based people putting more money in? Not really. This means internationally what's going on. It's also very rewarding. The S&P 500 index 1-year return with dividends from March 2020 to April 2020 was 56%, the highest since 1980. With equity continuously going up, it might seem appealing to diversify within equity instead of other asset classes in order to maximize returns and avoid diversifying the performance away. I got to tell you, short memories, right? I have clients asking for taking more risk, getting a greater return, because when was the last time we had a big dip? Right? So people forget about them losing half of their money 10 years ago. Now they're focused on what? I want to earn more. The greed factor is kicking in. That's what's going to cause some of the issues moving forward when things adjust and change. Diversification in other asset classes, namely fixed income and commodities, is still important as ever. Okay. Now, as asset classes, they're talking about fixed income and commodities only. There's other asset classes that we can look at that help provide a good diversification as well, not just fixed income and commodities. This is more focused on equities and that type of area, but there's plenty of other assets that we want to be able to focus on down the road if it sees fit and it makes sense for our client situation, is what we do. First, equity cannot continue to go up indefinitely. Okay, we understand that. We agree with that. Second, there is little diversification within equity and down markets. Okay, so that's key, right? There's little, that's a big thing to understand. Now, one of the things they talk about is what's called price earnings ratio based on cyclically adjusted. So Yale economist Robert Shiller is a valuation measure applied to the S&P 500 index, where company stock price is divided by, company stock price is divided by the average 10 years of earnings to smooth out sharp earning gains or drops, okay, and adjustments for inflation. A high ratio suggests markets are overvalued, okay, will eventually be corrected. Yes, okay. So let's look at this. So a median is 16, okay. A median is 16. Has rarely been seen above 30 historically. Okay. Now, it was 32.56 in September 2029 before Black Friday. All right. That was a big issue. It was at 44.2 in December 19 before the dot-com burst. Okay. And it was 30.73 in February 2020 before the global pandemic. Now, where does it stand today? 36.94 as of April. Diversification within equities tends to work when it's not needed and to not work when it's needed. Okay. So the key here, I think the biggest thing we need to take away from here is that volatility is high. Okay. And we need to understand that the equities will not indefinitely go up. And so by this statement, we need to be concerned about looking at other assets, maybe not necessarily fixed income assets, because quite honestly, a lot of times fixed income is correlated to what? Interest rates. And interest rates are still at historic lows. So what's the give and take? Like I said, there's other asset classes that I think are vital and important to an overall portfolio. And if you're a business owner, one of your best tools is your business, and being able to tax plan and be able to use your business, because quite honestly, the tax code is written for business owners. So how do you use your business, use your wealth and your investments and all this fun stuff to allow it to all work well together? That's the key, and that's the concern, is what asset classes among all asset classes make the most sense for you.